I'm Tyler Laundon. I'm the chief analyst of Cabot Small Cap Confidential and Cabot Early Opportunities, and I'm here with your Cabot Weekly Review. It is just after 10 a.m. Eastern Time on Friday, May 3rd, and we're going to jump back a few days, talk about the Fed, some macro stuff, and then we're going to jump into looking at four companies, small caps, mid caps, and one slightly larger company that all reported decent earnings and I think are worth you taking another look at. So let's zoom out, go back a couple of days. So, of course, the big event this week was the Fed meeting on Wednesday. Heading into that, I think it had been somewhat de-risked because we had already seen PCI inflation data, but there have been concerns about stagflation. And, of course, stagflation, it's economic growth with higher than desired unemployment with higher than desired inflation. And that's a bad scenario for the market and the economy, really, because it's tough for economic policy to fix it. Heading into the Fed meeting, the worst case scenario for that meeting was that the Fed was going to consider and open the door to another rate hike, which just seems insane that that would even be on the table. It seemed insane a couple of months ago, but that has been what people were concerned about. That scenario has been taken off the table, at least for now. So Fed Chair Jay Powell said it is unlikely the next policy move will be a hike in rates. Fed policy is restrictive. We believe over time it will be sufficiently restrictive to bring down inflation. So that is good. Powell also downplayed concerns over stagflation. I think if we step back, the punchline is that his press conference was neither too dovish or too hawkish. He kind of played it down the middle, and I think that the market liked that. I mean, that's what the evidence shows. Also, geopolitical risk has been tamped down over the last week, which is good. Yesterday, we had a decent market rally on Thursday, and the reasons for that, I think, are a unit labor cost inflation report. You can get into the nitty-gritty of this just for, give me 20 seconds or so. Bottom line is that unit labor costs were down year over year. Of course, labor costs have been a big concern of the Fed. The way that this number is calculated, just hourly compensation divided by productivity. So when productivity goes up, all else being equal, labor costs, unit labor costs come down. Now, economist Ed Yardeni says he thinks this reading, it's the most important measure of the underlying inflation rate in the labor market, and it's highly correlated with the CPI inflation rate when measured on a year-over-year basis. So having that year-over-year number come down yesterday implies CPI inflation rate should continue to come down. Therefore, theoretically, market rally, that's a good thing. Lower labor costs are a good thing for the market in this current environment. Moving on to 10-year yield. Of course, we've all been paying very close attention to yields. So last week, the market was kind of in trouble. One of the reasons is the 10-year yield here spiked up to 4.7%, just a little bit higher than that. And it started to fill in this gap between 4.7 and 4.8, which was definitely concerning. But it didn't, by the way, that gap was from November of last year. Thankfully, it didn't go any higher. It was looking like the 10-year could go up to 4.8 and even higher from there. Not a great scenario. It has backed off of that since. Definitely a good scenario. And this morning, we have a decent market rally going as of 10:15 at least. And I think that's driven by the April payroll report. It came in softer than expected. It showed weakening wage growth. Remember what I just said about the unit labor cost inflation report. Both of these help to kind of tamp down the higher for longer argument, and that is a good thing for the market, which is now pricing in a first rate cut in September, so that is being bumped up a couple months from November. Of course, these expectation percentages shift around depending on what's happening, but again, for now, it's a good thing, and you can see that the 10-year is down to 4.5% as of 10:12 a.m. Eastern Time on Friday, May 3rd, which is good. So, all right, let's take just a quick look at what the major market indices are doing. So the NASDAQ had a nice bump. It was up 2%. shortly ago. It's down to just being up 1.63%, which is still pretty good, all things considered. And small caps had a nice little jump this morning. The small cap index, it's still challenged by interest rates. We just need interest rates to the trajectory to be lower, and when that happens, I think small caps are going to take off. It's just that there's still a lot of variable interest rate debt in the small cap space, and the sooner rates come down, the sooner those companies will start to save on their interest expense, which could spur some growth and investment and all of that. So that would be a good thing. Okay, 4 stocks for you today. We're going to keep it pretty tight. So the first one here is Vertiv, VRT, 35 billion market cap company. You probably have heard of it. I'm bringing it up today because it is, as those of us that follow it know, it's basically the infrastructure company for playing AI. And as you can see, the company, the stock pulled back a little bit going into earnings and then had a very nice earnings report and reaction and back to almost new highs today. Now, Vertiv, it provides digital infrastructure solutions. So, and that's for AI applications, cloud software, data warehousing, all those kind of big mega tech. It powers all those big mega tech trends. It sells the hardware, power management, monitoring solutions. It's interesting if you were paying attention to Meta's earnings report and Microsoft's earnings report. Both of those management teams have talked about long-term investment cycles in AI, and that feeds directly into Vertiv and other companies that provide the infrastructure to support these technologies. So that's kind of what's going on there with Vertiv. Pretty interesting story. Next up is TransMedics, TMDX, and I've spoken about TransMedics before on these weekly videos. As you can see, the stock is doing very well. They had a just amazing earnings report. Stock was up nicely, and it's continued to add. So TransMedics specializes in technologies and supply chain solutions for organ transplants. I'm not going to get into the weeds of that, of course, but they are doing work with heart, lung, and liver. And beyond just the technology that they have for preserving organs while they're being, in transport, they are also getting into the aviation business to speed up transport and not have to charter flights at tremendous expense. They're taking more ownership over that whole supply chain. So it's an interesting story, and if you have time, I'd encourage you to dig into their earnings report, maybe listen to their conference call, because management does talk about the specifics of what they're doing. And I think it's one of these companies where the growth rate is so fast, over 130% revenue growth in the last quarter, that even, but it's still a fairly small revenue base, that just a few things going wrong or going better than expected can move that needle quite a bit. So just a super interesting story there. We'll move on to Tidewater. Ticker symbol here is TDW. Market cap is approaching 5.5 billion. It's an oil and gas services company. As you can see, stock is up today, so they reported yesterday. Nice report. Stock is up to new highs. They specialize in providing support to offshore oil and gas and the wind industries. It's one of the strongest areas of the global drilling and completion market. So they have a whole fleet of ships, and they've been investing in acquiring larger ships, and it is another very specialized business that's doing well. Even though crude prices kind of move around, it's not selling crude oil. It is providing the services for those that are drilling and producing and moving crude. So there's Tidewater. Check that one out. And last but not least is FTAI Aviation. Again, a very specialized business. I don't think that many people know about this one. Market cap is 7.7 billion. It is a small aerospace company. They specialize in aircraft and engine leasing, also repair and maintenance. Now, they do this specifically for the CFM56 engine. It's the engine on the world's best-selling aircraft for single-aisle commercial planes. It's the one engine for the Boeing 737 NG family and one of the only two engine options for the Airbus A320. The company, back in February, just started a program to do the other engine for the Airbus A320, and so they have that covered. And they basically are managing engines as assets. So they're buying, they're selling, they're repairing. Super interesting, especially if you've flown recently or you're about to look out the window at the engine and think about how, you know, those planes go in for service and they'll pop those things off, take them in, repair them, maybe put a new one on. All of that is interesting, and you can learn a little bit more about it and why it's a good business to be in right now if you dig into FTAI aviation. All right, guys, that's going to wrap it up today. Hopefully this market can hold on to these gains, but I think the message for the week is better than expected economic data, lower risk from the Fed, and yeah, hopefully we're on the right track and the market can continue to add to these gains. So hope you have a nice weekend, and we will be back in touch soon. Take care.